Gensler, yes, I was chair of the US Securities Exchange Commission. Unfortunately, can't join us today. We learned that last week, so we did manage to grab him. And I suppose one of the benefits of the past 2 years is we've learned that they don't always have to be on stage to actually hear from people. So we did have Katanga Johnson manage to grab Gary to have the discussion that was due to have on stage actually recorded. So I believe the team are ready to put that on the screen now. And if you can load up, because we just played the audio, so you've got a glimpse. And we'll play that, but we'll be back to a physical discussion on stage straight after this.
Of Responsible Business USA. I am Katanga Johnson, a financial regulation correspondent at Reuters in Washington. With me today is Gary Gensler, chair of the US Securities and Exchange Commission, who will share remarks on his agency's landmark proposal on climate risk disclosure, and then answer a few questions. Chair Gensler has previously taught at the MIT Sloan School of Management and has led the other US markets regulator, the Commodity Futures Trading Commission. Chair Gensler, it's a real treat to have you here with us today.
Thank you so much, Katanga, and it's good to be with you at the Responsible Business USA. As is customary, let me just say, I'd like to note that my views are my own, and I'm not speaking on behalf of the Commission or S.E.C staff. Now, as you know, in March, the Commission voted on a proposal to mandate climate risk disclosures by public companies. Let me try to put this proposal into the context of a long tradition of disclosures. This core bargain from the 1930s is that investors get to decide which risks to take as long as the public companies provide full and fair disclosure and, of course, be truthful in those disclosures. And over the generations, the SEC has stepped in when there's significant need for disclosure of information relevant to investors. The first disclosures, you'd imagine, around companies' financial performance, who runs the company, and the like. In addition, though, to such historical information, investors want to assess potential risk. And risks often, by their definition, are about the future, events that have not yet occurred. So in the 1960s, the SEC started to offer guidance around disclosures of risk factors. We later adopted disclosure requirements around management discussion and analysis that you know about, and the existing environmental related disclosures that started in the 1970s and 1980s and the like. And even in 2010, we put out guidance related to, yes, climate related disclosures. Across all of these disclosures, the same principle applies. Investors get to decide which risks to take as long as public companies provide full, fair disclosure and they're truthful. Now, the SEC has a role to play in terms of bringing some standardization to the conversation that's already happening between and amongst issuers on the one side, investors on the other side, particularly when the disclosure is material to the investors. And in making decisions on disclosure requirements under the securities laws about those decisions, including climate risk disclosures, I'm guided by our three-part mission about investors, issuers, and the markets in between. We're also guided by a concept of materiality, and the Supreme Court defined this. Think of it: substantial likelihood that a reasonable shareholder would consider it important making an investment decision. Forward-looking statements are part of that as well. I believe the proposed rule will build on that long tradition. Now, thinking about today's practices, the thing is, climate disclosures are already happening. And today, investors are already making investment and voting decisions using information about climate risk. Hundreds of companies are already disclosing information. The conversation's already happening. And many are using the Task Force of Climate-Related Financial Disclosure, the TCFD framework, and Greenhouse Gas Protocol. Interestingly, this TCFD was formed in 2017 amongst about 30 market folks, not government officials, market folks, and reported up to the Financial Stability Board. And 5 years later, that framework has been used by literally thousands of companies, and beyond just here in the US, around the globe. Brazil, the EU, Hong Kong, Japan, New Zealand, Switzerland, others are adopting that framework. One report even found that 70% of companies in the Russell 1000 publish sustainability reports. So today, investors representing literally tens of trillions of dollars support climate-related disclosures, Simply put, because they recognize climate risk can pose significant financial risk to the company, and investors need reliable information to make informed investor decisions. Companies, investors alike would benefit from clear rules of the road, and that's what I think we've tried to do in our proposal. And there's these concepts are adopted and been widely accepted around the globe. We're trying to build upon that. So let me just go through a couple things that are in that release and try to take some questions. First thing is the disclosures would be filed in the 10K rather than solely on some sustainability report or on the website. You might say, why? Well, investors look for the relevant information in filings like 10Ks when assessing investment decisions. That was true when I started on Wall Street several decades ago, 4 decades ago, who's counting? It's true in the management discussion and analysis section. It's true about risk factors. It's true about the environmental disclosures I mentioned earlier. It's important that investors find consistent, comparable, decision useful information in that one place. But further, placing disclosures in filings also benefits investors because there are more controls around the disclosures. And there's more controls we recognize do have heightened cost, but on balance, I believe that consistency along with enhanced control environment brings benefits to this regime. The disclosures themselves, let me just touch upon some main components. First is bringing consistency and comparability to how a management team discusses strategy, governance, risk management with respect to climate risk. Second is disclosures about companies who set targets, who might say, in the future, we have this goal in terms of our greenhouse gas emissions or something else. Also, disclosure about if a company has a transition plan, scenario analysis, or even uses internal carbon pricing. But the way we approach these 4 items, targets, transition, scenario plans, carbon pricing, is disclosure. If you have one of these, you would provide disclosure about it. But if you don't, that's up to you. It's up to the company to determine whether you have a target, transition plan, scenario, or carbon pricing. See, to the extent possible, disclosure would include this information, but we're a disclosure-based regime. It's up to you whether you have such tools in your toolkit. And if you do have forward-looking statement, such as projections of future risk and plans related to targets or transition, we've also said there would be a forward-looking statement safe harbor around that. Now, in addition, we looked at disclosures around the financial statement metrics. This is what's happening right now to your balance sheet, your revenues, your income statement. This would include the impact from climate-related events in the consolidated financials. And then let me say something about greenhouse gas emissions. The proposal would address disclosure of greenhouse gas data because it's increasingly being used as a quantitative metric to assess a company's exposure to a potential future effect of climate-related, what people call transition risk. And those risks could be regulatory, they could be technological, they could be market risk, they could be supply chain risks, with potential financial effects on your revenues and business. All filers would disclose what's called Scope 1 and Scope 2. These emissions result from direct or indirectly from facilities owned and the activities controlled by the registrar. Under the proposed rule, we take a layered approach to what's called Scope 3 emissions. These are the emissions of the upstream and downstream. You might say your value chain. And what we looked at here is said the disclosures would only be required, 1, if they're material, back to that concept of materiality, or 2, if the company had made a commitment referencing Scope 3. You have a goal out in the future. So if you've made the commitment, the information, or if the information is material, the sense is measure it, report it. Now, we propose something different because we think that scope 3, the methodologies determining or currently aren't as well developed, and the proposal would phase it in later. And we also put a safe harbor around, a different safe harbor around this as well. Before I close, let me just say, it's really going to be important to get feedback on all of our proposals, not just on climate risk proposals, to get feedback from the public. Some are already weighing in, some positive, some negative. We need both sides of this discussion, but we really do need from investors, whether it's chief investment officers or individual investors, how are you using each of these areas in your investment decisions, whether it's greenhouse gas, whether it's the financial metrics, whether it's about strategy and risk and governance, how investors are actually putting it into their investment decisions. And from the issuer side, how we can help bring, as I say, some standardization, consistency, comparability, decision usefulness with this in mind. So I thank you, and I turn it back to Katanga to take questions.
Thank you, Chair Gensler. You mentioned that some commenters have already begun to file letters on this measure. There's an understanding that there may be some sort of legal challenge to whatever final rule the agency issues. I just wanted to better understand maybe your thinking and preparation around any potential challenges to what the agency has already said in its proposal.
Like I said in my opening remarks, I think this builds upon a long tradition, that basic bargain that Congress put into the law. Investors get to decide, but issuers make full and fair disclosure. And what we found in the last number of years is investors are already making decisions about climate risk disclosures, and hundreds, if not thousands, of companies are already making disclosures. So our role, trying to bring consistency and comparability. The public input we got last year, we put a notice out last year, we got 600 different unique commenters, 2/3 to 70% were supportive, but the details matter. So now we've put out a proposal with the details, and to hear from investors and issuers what works, what doesn't work, and then based upon that and the economics and our legal authorities, which are quite clear, I believe that we have a role to play and an important role to bring some consistency and comparability here.
The proposal has certain carve-outs around Scope 3, and you spoke to those in your keynote. I'm just curious about any expectations about the number of companies that might be captured by the Scope 3 requirements. Is there?
I wouldn't want to speculate, but I would say this: we consciously left out small reporting companies. So I would say this: there's only about, I think, 1,600 or so what's called accelerated filers. So it's certainly narrowed down there. But amongst them, a fair number of companies have made commitments and targets to their future, including Scope 3. And again, if a company has said to the public, including their shareholders, we have this future goal, then we thought, subject to public comment, but we thought it does make sense that you've made that goal, that shareholders want to know, what are you planning and how are you planning to get there? And how are you currently measuring against that goal? And of course, if it's material, there's, one would say that's an important requirement as well.
Beyond climate risk, the agency has proposed a number of other measures that relate to disclosures for issuers, including a few around cyber risk and pay versus performance, among others. And I'm curious about any interesting engagement you've had either with the industry or with perhaps investor advocates, even if only anecdotally, around these disclosure proposals.
I think it builds on our long history. And for those corporate issuers that are in attendance to this today, very well, you have investor relations departments, you do your quarterly calls, you meet with analysts that cover your companies, and cyber risk is an increasing risk for our economy writ large. If somebody comes in and takes 100 million of your customer data files, or if you find yourself in the unfortunate position where you're paying ransomware or you're shutting down something like a pipeline, it can become a material bit of information for your investors. So we did put out a proposal. Again, please comment in on it around cyber risk management, meaning the proposal is to disclose how you manage those risks and so forth, and then incident reporting when it's material.
Would you be willing to provide any update on discussions that you've said in public, even to us at Reuters, just about the human capital management disclosure proposal? I just wanted to better understand how this, when it is issued, how this might fit into the broader.
So one of the key assets of any business are the workforce itself. So the prior commission put out something in 2020 about what was called human capital management. And those disclosures, we've had one filing season was 21. We're seeing another filing season this go again. And looking at least at that first year, but we're going to be looking at this second year as well, as to what enhancements we can do there about this critical part of the value, fundamentally the value proposition of a company, human capital.
And Chair Gensler, just to close out our session, I must ask, as you celebrate, I think this past weekend, 1 year in the office as S.E.C. chair.
Oh my God, yes.
There's a volume of proposals that you've issued, even just since January of 2022, that many have celebrated. Some have been very skeptical of whether you're able to actually bring all of these proposals across the finish line. But even with this sort of response out there to your time in the office thus far, I was curious about how you're forecasting your agenda and how that might change moving forward, particularly as we think about potential changes on the commission very soon.
So one, it's a remarkable privilege to serve, and it's this great agency. The S.E.C. has a terrific staff, 4,500 strong, and we oversee $100 trillion capital markets. So we've put 25 or 30 proposals out to comment. We still have some more. We're going to be working through 2022, proposing a number of things. Equity market structure is one area. Treasury clearing is another area in the market structure area. But it's all on our public unified agenda, and we're going to turn to based upon the public feedback, start to think about adopting some of these. Some probably by this summer and into the fall, but certainly throughout 23, you could imagine. And I couldn't be prouder of this agency and just is remarkable talent at the agency. And as to the commission, I've been honored to serve now with 4 colleagues, one who decided to leave us in January. I miss a lot. It's terrific to work with Elad Roisman. But that's the nature of commissions, is we collaborate, we debate, we discuss. It's 5 different points of view, 5 staffs, and we try to do our work within our 3-part mission for the American public.
Chair Gensler, thanks so much for your keynote and for your responses with us today at the Responsible Business USA.
Thank you so much, Katanga, and be well.